Prospector News is media for educational purposes only and should not be construed as advice. We are not a certified financial analyst, licensed broker, or fund dealer, exempt market dealer, or hold a license to provide financial advice. We provide no legal opinion regarding accounting, tax, or law issues. Nothing in this podcast should be construed as investment advice or the solicitation to buy or sell stocks or commodities. All opinions expressed are those of the participants and should not be relied upon when making investment decisions. Those decisions should be made with the advice of a personal financial advisor. If you have enjoyed our podcast, please hit the like and share buttons and be sure to hit subscribe. Hi, I'm Michael Fox, and this is the Prospector News. Joining me, I have Jeff Christian, the managing partner of the CPM Group, and we're going to talk about silver today. Hi, Jeff. How are you doing?
I'm pretty good. Pretty good.
Good. So, for those that aren't aware of the CPM Group, can you give us the quick elevator pitch as to who you guys are and what it is that you do for the markets?
Sure. I started CPM Group in 1986. And prior to that, I was the head of commodities research at J. Aron when it was an independent commodities trading company. And then we merged into Goldman Sachs. And then I spun off what was the commodities research group at Goldman Sachs, J. Aron, and created CPM Group. And the program, the operation goes back to the late 60s, early 70s. We produce basic data on gold and silver and platinum group metals and other metals where the data doesn't exist. So, gold and silver, we're talking silver today, they're very secretive markets. Mine production, mining companies are public. They have regulatory requirements to disclose information. They have an economic interest, which is they want investors to invest in their companies. So they give out a lot of information. But you look at the rest of the silver market or gold or platinum, and it's secondary recovery from scrap, fabrication demand, investment demand. None of those groups have any requirements to disclose how much gold or silver they're using if they're a fabricator, or refining if they're a scrap refinery, or investing. And they all have economic interest in not disclosing that information. So they're very secretive industries, and they always have been. So back in the late 60s, early 70s, J. Aron created this research department to cobble up statistics on gold and silver and make estimates, the best available estimates, with the idea that if you could get the market right, you could beat the market and make money. And I took over that department in 1980 and then created CPM Group out of it. And we're the only independent company in the world that collects and makes these estimates for gold, silver, platinum group metals, supply and demand, that isn't either owned by or has as its major outlet and clients people who promote and sell precious metals. So we're fully independent company. I'm the major owner. The other major owners, the other owners are my employees and some ex-employees who have hung on to their stock. And we're independent of all entities. We supply our research primarily to institutional investors, high net worth individuals, family offices, fabricators, mining companies, refiners and smelters, central banks for gold, and other groups in that anybody who has a large exposure to precious metals. So we have our client base is spread across the market. They don't pay us to be bullish. They pay us to get it right.
Perfect. That's what I love about it. Numbers never lie. Data is what the data is. So,
yeah, I mean, the data it's tough because these are very secretive markets. There have been analysts who have made the mistake of going to the wrong part of the gold market and saying, hey, how much gold are you buying? and had a gun stuck to their face. I have not had that happen. But yeah, these are secretive markets. It's a tough place to come with numbers. But if you look at our price projections since 1980, when I started keeping track of them, when I went to J. Aaron, we have a pretty good track record calling the market, all of these markets. And that's predicated on our macroeconomic research and our fundamental research. And if we weren't getting the fundamentals of supply and demand correct, the price projections wouldn't be as good as they have been. So the fact that we've been pretty good at calling these markets in the long term over the last 40 years, 42 years now, sort of tells us that our statistics are pretty accurate.
I would hope so. If not, somebody's paying you for a lot of garbage, and most people don't do that. So moving into the silver markets, I've always personally considered silver to be a bit of a bipolar metal. It's part industrial and part precious metal, and that's got to be a challenge for you to try and pick out the supply demand curves out of that market. What's more important? Is it the industrial side or the precious metals side?
I guess it depends on how you define more important. Industrial demand, the use of silver in fabricated products, and a lot of that is actually jewelry and silverware and silver decorative objects and stuff like that. But in terms of fabrication demand, the use of silver in objects, solar panels, electronics, batteries, solders, all sorts of stuff, mirrors, glass. Fabricated use of silver is 10 times as much as investment demand for silver. So what fabrication demand does is it provides the solid base of offtake, which is relatively stable year to year. It tends to go on. The price changes have relatively minor effects on fabrication demand. Economic cycles obviously apply, but this is this base that takes off 80–90% of newly refined silver bullion coming into the market every year. And that's a very important function. The investors take up the last 10 or 15% of it, and they can come and go, and they have dollars and a lot more discretion in whether they're buyers or sellers or just absent the market. And so the investment demand, while it's much smaller than the fabrication demand, has a much more dynamic effect on the price of silver and the changes in silver. You probably don't see fabrication demand changes driving the price of silver up 27% the way it rose in 2020 on an annual average basis. But you do see a surge in investment demand driving the price of silver up or down.
Given speculation is mainly on the investment side of the equation, how is it that your group accounts for speculation in a market such as silver?
Yeah, I really hate to sound, didactic, but again, it sort of depends on how you define speculation. And, I can tell you funny stories about the way the Indian government defines speculation, because it's really a problem for people who are investing in silver in India. But, I look at speculation as short-term buying and selling by investors. And when I look at the price of silver and people say, well, what is it? Is it physical demand? Or is it futures and options that drive the price? My view is that the futures market determines short-term price moves. And when I say short-term, I'm really talking about intraday, but also, day to day, week to week, sometimes month to month. But it's the fabrication, it's the investment demand for physical metal that determines the longer term price. Now, some of those people who are investing in silver, physical silver, are long-term investors. And some of them are actually relatively short-term investors that if you looked at their trading patterns, you'd say, well, this guy's speculating, he's not investing. And then there are other people who call themselves silver stackers. And when you talk to them about them investing in silver, they say, no, we're not investing in silver, we're just stacking it up. Well, that's semantics. The reality is if you're buying it and not using it, you're investing in it. So you have different levels of investment demand. And I think most people think of speculation as the shorter term investors, either if sometimes physical, but more often they're involved in futures and forwards and options, and increasingly the ETFs.
I see. So when we hear that there's a silver shortage, we're talking about the speculative market for rounds and bars. Is that correct? There's no real silver shortage as far as the industrial side of the equation goes.
In terms of 1,000-ounce bars, there's as much silver as you want. And, the silver market is very well supplied. There are probably about 5 billion ounces of silver in above ground inventories, either in bullion or in bullion coins. So there's plenty of silver there. When you see a shortage of silver eagles or maple leafs, it's because of issues related to blanks and the supply of blanks and the quality of blanks being made and the supply of those coins, because the coin demand varies so sharply, plus or minus 50% sometimes year to year and month to month. The mints have a trouble sort of saying, well, how do we build enough inventories to meet demand when it surges, but not so much inventories that we're sitting on this metal with price exposure off sometimes for an extended period of time. So the mints have to try to guess how much investors are going to want in the future. And that's a very difficult thing to guess. And sometimes they get it wrong and there's not enough silver. We've seen over the last few years some interruptions with the quality of blanks. There have been some quality issues with blank manufacturing. The US Mint is the most stringent purchaser of silver and gold blanks that in the world. They have very tight quality controls. And there have been some issues with blanking qualities, which have further exacerbated the shortage of coins. But yeah, there's plenty of silver bullion around. It's a matter of availability of, as you said, coins and small bars.
So when we gather up all of our data, both industrial and investment side of the equation, what does the snapshot of the silver market look like right now?
Right now, in 2022, 2020 and 2021 were very strong years. And you saw the price of silver, go from $14, I guess it was $12 at the beginning of 2020, and then it shot up to $29. And then it came back off, $29 in August, came back off. And what you saw was that really from 2015 into 2019, investors had backed away from gold and silver. They came back like gangbusters, really starting in the second half of 2019, and then it got much more intense in 2020. And you saw, if you just look at coin sales, coin sales went from 84 million ounces to 115 million ounces, 2019 to 2020. And so you had this surge of investment demand. If you look at total investment demand, including bars, it doubled. It more than doubled. It went from, it about doubled. It went from 37 million ounces in 2019 to 65 million ounces in 2020. And that led to this push in prices. That continued in 2019, and investment demand went from 65 to 97 million ounces from the looks of it. And this year, we think it's going to be a little bit lower. Our projection right now is about 76 million ounces for this year. So that's still high, and it's still a strong level of investment demand, but it's not as intense as it was in 2021.
So so what I'm hearing is that we're a little bit bearish short-term, bullish long.
Exactly. We're looking at a silver price. Our expectation is the silver price will be somewhat weaker in the second and third quarters. And, we saw some of that weakness at the end of April, continuing into the first couple of trading days of May. Our view is that the price is sort of sideways, continuing this consolidation that we've seen for the last several months. And then later, possibly as early as the fourth quarter of 2023, but more likely over the course of 2022, but more likely over the course of 2023, we think that investment demand will start to rise again. And that will push silver prices up sharply, maybe not sharply in 2023, but over the next, say, 4 or 5 years, we do think that the silver price will rise substantially.
And what's going to be the catalyst for this?
It's going to be some combination of economic and political issues. And, you'll notice that in that 4-year period of rising prices, we have the 2024 US election, which I think will probably be pretty nasty and ugly and worrisome to reasonable people, using the legal term reasonable person. But, I think that it's going to be a combination of economic, financial market, and political issues. And it's not just the US that is having problems. There's a lot of political issues in Europe and in other parts of the world that probably are going to get worse before they get better. So you've got some political issues there, both domestic in different countries and on an international basis. Obviously, you have the war of Russia invading Ukraine, and that'll be resolved at some point, but the post-war implications are probably more dramatic and more important to gold and silver investment demand and prices than the actual war itself. But then you're going to have financial issues. We think there'll be some problems in the debt market. We don't think it's going to be in the Treasury because, quite frankly, the Treasury is the least risky part of the market, and it's the most closely watched and studied. We think that, if you look at past financial crises, they didn't start in the US Treasury market. They started in some obscure corner of the debt market. It might have been Russian sovereign debt in 1998, or Thai sovereign debt in 1997, or the collateralized mortgage obligations in 2007, or real estate in 1990. It tends to be some relatively obscure part of the debt market where the problems start, and then they compound. And once that happens, it often coincides with a recession. And you have an economic crisis, you have a financial crisis, and a lot of times there's some political things going on at the same time too. So it's going to be some combination of those things. I don't think it's going to be the Treasury market. Don't think the dollar is going to collapse, but I do think that there will be issues in debt because the world has loaded up on debt.
Yeah, and if the Fed's going to raise interest rates, I could certainly see that causing a problem.
Yeah, I think the Fed has the capacity to raise interest rates sufficiently to quell inflation without throwing us into a recession, but that's a very difficult dance.
Yeah, I was referring to the debt crisis could come from the Fed going just a little too far and people not being able to meet their obligations because of it.
The Fed's learned a lot in the last 40 years since Paul Volcker took it over in 1979, the Fed and other central banks. And, on a certain level, they've learned how to manage crises a lot better. But on the other hand, in the last, say, 6 to 10 years, you've seen a politicalization of monetary policy at the Fed and in other governments too. And that's much more worrisome because all of a sudden you have politicians saying, you can't do this to my reelection chances.
Yeah, the Fed is supposed to be, aside from the politics, but it always seems to get dragged into the muck with the rest of them at times.
Well, it's funny because George H. Bush blamed the Fed for his losing the 1992 election. And, everybody said, no, George, it was you. But the Fed had raised interest rates in 1992, and he thought that contributed to his losing the election. And as a result, for many years, the Fed stopped raising interest rates during presidential election years because they didn't want to have somebody accusing them of sabotaging their reelection bids. But again, you've seen a greater politicalization really starting under George W. Bush at the Fed and at the Treasury than you used to have. And that's worrisome because I'll trust a monetary authority long before I trust a politician.
Yeah, you and me both. I don't know about the United States, but in Canada, we got to stop electing idiots.
Yeah. R. Buckminster Fuller had a great theory that because we identify smart people at ever younger ages and we channel them and focus them into specialties, that leaves only the less intelligent people to become the managers and politicians.
Yeah, that seems pretty accurate. When I look at the silver markets as the gold and the other precious metals markets, one of the things that I like is that you folks come up with these wonderful yearbooks that really give a good synopsis to the data that you've collected. And I understand the silver yearbook is coming up very soon.
Yeah, we will release the 2022 silver yearbook on May 10th. And yeah, we've produced these reports have been produced since the early 70s in J. Aaron. I mean, long before I came there. But they've gone through the J. Aaron and the Goldman era, and then they've been the CPM Group era since 1986. And the next one, these things are about 200 and 220 pages long. And the next one comes out May 10th. We'll have an online briefing where we'll run through the main conclusions and findings. And that's open and free to the public.
How does one register for that?
I think if you go to our website, cpmgroup.com, I know you can order the book there, but you can probably also find a link to a registration at GoToWebinar.
Well, we've got a banner up on our main page, the Silver Yearbook. You can also click through that and get to your registration page as well. So
you're more organized than I am.
It's the delusion of competence. I like to pretend that I'm competent when I'm not.
Okay.
Now, what other silver events do you got coming up between now and PDAC, and how do people participate in those?
All right. Well, first off, we have May 10th with the Silver Yearbook release and briefing. Then the following week on the 17th and 18th, I will be at the VRIC, the Vancouver Resource Investment Conference. I'll be giving a talk on gold and silver supply, inventories, and reserves. I'll be participating in a silver panel discussion with Jeff Clark and somebody else. And I will have an open forum there, which will be an hour-long Q&A in the evening after the conference is over. They've set aside a room and we'll go in there, no formal presentation, just open question and answer period. And then within the VRIC, the Yukon Mining Alliance has asked me to speak about gold. So I'll be doing all of that the 17th and 18th of May in Vancouver. And then we will have an open forum for our clients online. We'll have another silver seminar on June 1st in advance of the Prospectors and Developers Association of Canada conference. And then we will be at the PDAC making a presentation on precious metals there as well.
Wonderful. So whether you're in Toronto, Vancouver, or just at home and being able to jump online, there retail investors going to have lots of opportunities to get the data from your group.
Exactly. The data and the analysis.
Wonderful. Is there anything that we haven't touched upon on the markets today that the investors should be aware of?
Well, yeah, I mean, right now this week, we're speaking on May 3rd, and we're looking at the FOMC will raise interest rates tomorrow, and we're going to see how that goes. A 50 basis point increase could hit the markets again. But if they look at the weak GDP and the war in Ukraine and say, well, maybe we should be a little bit more cautious in raising interest rates and only raise them 25 basis points, that could lead to gold and silver prices rising. And then there's the war in Ukraine, which is, it can and will cut both ways, pushing investors into greater concern and more demand for gold and silver, and then less demand later. But, those are the two big uncertainties that we're looking at between now and May 10th. Yeah.
Wonderful. So everybody needs to gather up and sign up for the May 10th Silver Yearbook launch. They can buy the actual Silver Yearbook after that launch, correct?
They can pre-order it on our website and they can buy it afterwards. It comes as a PDF. So when you buy it, you get it immediately as electronic ebook. And then the last page says, if you run a printed version, you can take this PDF down to the local copy shop. Here are the specifications to have it printed, bound, and perfect bound book, the way we used to do it when we could rely on the USPS to deliver books.
Wonderful. Thanks for joining me, and I look forward to seeing you in Vancouver.
I'll see you there, Michael. Thank you.
Thank you.